The fundamental difference between professional speculation and amateur gambling lies entirely in the disciplined method of building a position. Jesse Livermore, the greatest speculator of his age, understood that true wealth was not made by catching the exact bottom, but by scaling into a confirmed trend with an ironclad set of rules. His system, known as pyramiding, is often misunderstood and frequently confused with the disastrous practice of averaging down. Pyramiding is exclusively the act of adding to a position that is already showing a substantial profit, using that paper gain as the risk capital for the subsequent purchase. This mechanism ensures that the market itself is financing the expansion of the trade, protecting the speculator's original capital from undue risk. The core principle of Livermore's success was his unwavering adherence to scaling into winning trades only. He recognized that if an initial position immediately went against him, his analysis was premature or fundamentally flawed, demanding an immediate exit. Averaging down, conversely, is the practice of adding to a losing position in the desperate hope of lowering the average entry price, a habit he deemed suicidal. Livermore believed that the market always tells the truth, and fighting a loss by increasing exposure is the surest path to financial ruin. His pyramiding strategy was designed to align the speculator's capital with the market's confirmed direction, maximizing gains once the path of least resistance was established. This discipline was deeply rooted in patience, requiring the speculator to wait for the market to prove the initial hypothesis correct beyond a reasonable doubt. Scaling in too quickly or based on minor fluctuations defeats the purpose of the method, turning a controlled strategy into reckless overexposure. Livermore emphasized that the goal was not to be fully invested instantly, but to build a massive position only when the surrounding market action confirmed the viability of the major movement. By waiting for the line of least resistance to be clearly established, the trader ensures that subsequent additions are supported by powerful market momentum. This careful, measured approach is what separated his consistent success from the erratic gains of less disciplined traders. Before we delve deeper into these crucial steps that separate the masters from the masses, please take a moment to subscribe and leave a quick comment. Even just a single word helps the algorithm recommend this video to more people, showing me that this kind of deep content truly matters and is worth the extensive effort required for creation. This simple action significantly boosts the channel, allowing more traders to benefit from Livermore's timeless wisdom. Remember to return to this channel during challenging times, especially when trading becomes difficult and your confidence starts to waver, as discipline is your greatest asset. We must now turn our attention to the very first practical step Livermore took in initiating any major campaign. Every single campaign Livermore undertook began with what he termed the trial balloon or the pilot trade. The purpose of this initial entry was purely investigative, serving as a low-risk probe to test the market's immediate reaction. This test trade was deliberately kept very small, often representing only a fraction of the total capital intended for the full position. The size limitation was critical, ensuring that if the market immediately reversed, proving the trade premature or incorrect, the resulting loss would be negligible and easily accepted. The trial balloon is essentially a question posed to the market. Is this the time to move? Identifying the precise entry point for this initial purchase required careful observation and technical analysis, even in Livermore's era. He typically initiated the test position based on a fundamental analysis of a specific commodity group or a stock showing strong relative performance. Crucially, he waited for the price to break out of a well-defined consolidation or congestion area before entering the market. Entering during the consolidation phase itself risked getting trapped in sideways action, draining capital and patience unnecessarily. The breakout signaled that the balance of power had shifted, providing the necessary confirmation to warrant the pilot trade. Livermore understood that waiting for the congestion to resolve itself was far more profitable than guessing the direction prematurely. Immediately upon establishing this small trial position, Livermore instituted rigorous risk management by placing an initial stop loss. This stop loss was positioned just outside the breakout area, typically below the recent low for long trades or above the recent high for short trades. The stop needed to be tight enough to protect capital but wide enough to allow for natural market noise or minor retracements. If the initial position immediately showed a loss and hit that stop, the trade was closed instantly, and no further additions were even considered. Closing the position instantly upon realizing a loss was a non-negotiable rule, reinforcing the discipline of never averaging down. Livermore would then step back and reevaluate the market, recognizing that the initial timing was simply wrong, even if the fundamental thesis remained sound. He viewed the small loss as the cost of gathering valuable market information, confirming that the line of least resistance had not yet been established. Only when the test trade showed a clear immediate profit was the speculator permitted to move to the second, crucial step of scaling up the campaign. Moving from the trial balloon to the first edition requires explicit market confirmation, which is the most difficult psychological hurdle for many traders. The price must not just move slightly past the entry point, but it must establish a clear, substantial profit buffer above the initial cost. This confirmation typically meant that the stock had moved through a critical resistance level, demonstrating genuine institutional buying power and confirming the breakout's validity. Without this clear establishment of profit, the trade remains speculative and vulnerable to quick reversals. The rule governing the first edition is conservative and protective, demanding that the profit on the initial segment be substantial enough to cover the risk of the entire combined position falling back to the original entry price. Imagine the initial position makes a 10% profit. The first edition is only warranted if that 10% profit buffer can absorb the potential loss should the market turn against the larger combined position. This systematic risk calculation ensures that the speculator is essentially risking the market's money, not their own fixed capital. The first ad is therefore not merely increasing size. It is a profound confirmation that the trend is truly underway and is powerful enough to support increased exposure. Once the successful first edition is executed, the immediate and mandatory action is to adjust the stop loss upward. This adjustment should move the stop loss to a point that protects the combined average entry price, or even better, guarantees a small risk-free profit on the initial segment. The goal here is to transform the trade from a speculative venture into a risk-controlled campaign, where capital preservation is paramount. Livermore would often move his stop to the break-even point of the initial segment, essentially guaranteeing that his pilot trade was profitable, regardless of subsequent market behavior. This proactive stop-loss adjustment is the practical implementation of using profit as a shield against potential reversal. By securing the initial gain and protecting the average price, the speculator establishes a powerful psychological edge, knowing that the worst-case scenario is now a small profit or a break-even exit. Livermore would never allow a profitable, confirmed trade to deteriorate back into a loss, viewing such an outcome as a grave failure of discipline and risk management. This phase requires patience, waiting for the market to validate the increased commitment before proceeding further into the pyramiding process. The crucial, often misunderstood element of Livermore's pyramiding is the strict requirement for decreasing increments in size. Unlike amateur traders who might add equal amounts or even increase size as the stock rallies, Livermore dictated that each successive edition must be smaller than the previous one. This means if a speculator intends to buy a total of 500 shares, the structure might look like 200 shares first, then 150 shares, then 100 shares, and finally a small 50-share increment. This specific, non-equal scaling is mathematically vital to the strategy's success. The mathematical necessity of decreasing increments lies in protecting the overall average purchase price. If the speculator adds equal or increasing amounts at higher prices, the overall average entry price is rapidly dragged up closer to the current market price. This narrowing gap between the average cost and the market price greatly increases the vulnerability of the entire position to a sudden, sharp reversal. A protected position requires a wide margin of safety, allowing for natural market corrections without triggering the protective stop loss. By utilizing smaller additions as the price rises, the speculator ensures that the majority of the position was acquired at the lowest price points. This maintains the maximum possible profit buffer between the average cost and the current price, preserving the inherent safety of the trade. Livermore recognized that the highest risk additions are those made closest to the potential peak, and therefore, those additions must carry the smallest weight in the overall campaign. This technique forces discipline and prevents the euphoria of a rising market from leading to reckless late-stage exposure. The waiting periods between these additions were equally critical, emphasizing time and confirmed price movement over fixed price intervals. Livermore did not add simply because the stock moved up 2 points. He waited for confirmed substantial market movement that often spanned days or even weeks. He needed the market to prove that the previous addition was warranted and that the momentum was strong enough to support the next increment. Patience is the silent partner in this step, ensuring that the speculator is following the market's tempo rather than imposing their own arbitrary schedule upon the trend. Pyramiding must cease once the position reaches its predetermined maximum size, or when the market exhibits specific signs of extreme acceleration and climax. Livermore understood that attempting to squeeze out the very last fraction of profit by adding close to the peak drastically deteriorates the risk-reward ratio. The final increments are the most dangerous, and professional traders know exactly when to stop building and shift entirely into management mode. Continuing to add past the point of maximum intended size is a sign of greed, which inevitably leads to catastrophic reversals. Once the maximum size is reached, the focus shifts entirely to managing the protective stop loss, transforming it into a trailing mechanism that secures accrued profits. It is crucial to maintain a stop loss that is wide enough to allow for the natural, necessary reactions and retracements that occur even in strong trends. Placing the stop too tight guarantees being shaken out by minor volatility, forfeiting the opportunity to capture the major move. The stop loss is only moved upward when a new confirmed consolidation base is formed, securing the majority of the accrued profit below that new support level. Livermore was meticulous about securing profits without stifling the trade's potential. He aimed to ride the major movement until the market structure visibly broke down. He did not use percentage-based stops, but rather structural stops, based on where the market proved the trend was still intact. This structural trailing mechanism ensures that the trader captures the lion's share of the move, only exiting when the market explicitly signals a change in the line of least resistance. This methodical approach removes emotional decision-making from the exit strategy. Crucially, Livermore learned to recognize the specific warning signals that mandated halting all pyramiding activity, regardless of whether the maximum size was reached. These signals included visible signs of distribution or professional selling activity appearing in the market action, often accompanied by widening ranges on declining volume. Another major warning was the price failing to follow through after a significant breakout, indicating a sudden and profound weakening of momentum. Recognizing these signs required constant vigilance, but stopping the pyramiding process at the first sign of trouble prevented the average price from being dangerously inflated near the market top. The failure of a stock to react normally to good news, or its inability to hold gains after a powerful rally, signaled that the big money was exiting the market. Such indications immediately halted any thought of adding further capital to the position, confirming that the speculative campaign had reached its natural limit. Livermore's discipline demanded that he manage the existing position defensively once these subtle but powerful warning signs appeared. He knew that the market never stands still, and the phase of accumulation and pyramiding must eventually yield to the phase of distribution and exit. Livermore's spectacular success was not built on luck or intuition alone, but on 3 consistency pillars derived from his disciplined pyramiding strategy. The first pillar is the absolute non-negotiable rule of never averaging a loss, which prevents small errors from escalating into financial disasters. This discipline protects the speculator from the emotional and mathematical trap of fighting the market, ensuring capital is always preserved for winning campaigns. He understood that a loss is a signal that the premise is wrong, and adding to a wrong premise is folly. The second pillar dictates using profits as the only source of capital for scaling into a position. This ensures that the risk exposure is controlled by the market's generosity, not the speculator's fixed capital. By risking profits, the trader shifts the psychological burden, making it easier to hold through volatility and reducing the fear associated with large positions. This mechanism institutionalizes the concept of letting your profits run, as the risk is mitigated by the established buffer. The third, and perhaps most sophisticated pillar, is the mandatory use of decreasing increments to protect the overall average price. This mathematical trick ensures that the position maintains maximum room to maneuver without hitting the protected stop loss, regardless of sharp market retracements. By buying the largest quantities at the lowest prices, the speculator maximizes the leverage and minimizes the average cost, securing the structural integrity of the entire campaign. This careful scaling technique is the hallmark of professional position building. The power of successful pyramiding is that it allows a disciplined trader to capitalize maximally on the major moves, the segments where the true big money is made. Livermore often described his goal as capturing the meat of the move, not the extreme edges, and pyramiding is the perfect tool for achieving this. It ensures that the largest capital deployment occurs during the most confirmed and robust phase of the trend, magnifying the returns exponentially. This strategy turns small, tentative entries into massive, protected campaigns. Final emphasis must be placed squarely on patience and the necessity of waiting for the market to perform the necessary work. Livermore was often inactive for months, waiting for the perfect setup and the clear confirmation that the line of least resistance was established. Pyramiding is not a rapid-fire trading technique. It is a methodical, slow build that requires tremendous self-control to execute correctly. Success in speculation is ultimately achieved by letting the market prove itself right before committing substantial capital. This systematic approach to building positions is exactly why Livermore's life story remains the essential text for anyone serious about the markets. If you want to delve deeper into the mindset and practical strategies that defined his career, you need to read the definitive record of his wisdom. We highly recommend the new edition of Reminiscences of a Stock Operator, Edwin Lefebvre's classic work that details Livermore's psychology and trading strategies. This updated edition offers a profound analysis of his discipline, supplemented with unique commentaries and chapter breakdowns that transform his historical experience into immediately applicable lessons for modern traders. Do not just read the story. Study the blueprint for success by picking up your copy today. The direct link is provided in the description below. Livermore's legacy teaches that consistency is not about being right every time, but about being right in size when the market confirms your view. It is about accepting small losses quickly and allowing confirmed winners to grow into campaigns that yield enormous life-changing profits. Mastering the art of pyramiding is mastering the art of controlled risk and maximized opportunity.